Okay, let's dive right in and explore this explosive Q1 2026 earnings beat that sent Newmont Corporation's stock absolutely soaring. Today, we're unpacking the financial mechanics behind the world's largest gold mining company in this explainer. Now, if you've been watching the commodities market, you know gold has been on a historic run, breaking back above that massive $4,000 an ounce level. But how does a macroeconomic trend like that actually translate to real corporate profits? Well, Newmont just gave us an absolute masterclass in operating leverage.
And this 8.41% jump in Newmont stock price right after their earnings report, yeah, that wasn't just a modest bump. This was a powerful breakout driven entirely by those rising gold prices and a profoundly dominant quarterly performance. The market essentially woke up to the fact that Newmont is perfectly positioned to capture the upside of this precious metals rally.
Section 1. The Golden Quarter.
To really understand the price action, we have to look under the hood at the raw data. Wall Street analysts are usually pretty dialed in, right? And their consensus estimate for Newmont's Q1 earnings per share was $2.07. But Newmont, they posted a staggering $2.90. That is a stunning 83-cent beat. In the world of large-cap mining, surpassing consensus by a margin that wide is incredibly rare, and it signals that something fundamentally shifted in their operating environment during the quarter.
So the crucial point here is this dramatic 45.8% year-over-year revenue jump. Just look at that growth, going from $5.01 billion in Q1 of 2025 to $7.31 billion in Q1 of 2026. What fueled this? A massive 66% surge in realized gold prices. For anyone who holds gold or mining stocks in their portfolio, this is exactly why it matters. Mining is a business with heavily fixed costs, so when the price of your end product spikes, that extra revenue flows straight to the top line.
When we look at their elite profitability, it's not just about the gold price going up. It's about what management actually did with those rising prices. They maintained incredible cost control. Their cost of revenue was just $1.94 billion against that $7.31 billion in total revenue. That yields a staggeringly rich 67% gross margin. And that sheer efficiency resulted in over $3.26 billion in net income directly attributable to common shareholders for the quarter.
Section 2. Building a mining giant. You don't just wake up one day and generate $7 billion in a single quarter by accident. To understand how they captured this market momentum so effectively, we really have to look back at how Newmont built their global scale. From its founding over a century ago back in 1921 to today, it's been a fascinating story of strategic evolution. The modern Newmont was really forged through highly targeted acquisitions. They absorbed Goldcorp in 2019 for $10 billion and then executed a blockbuster $19 billion takeover of Newcrest in 2023, totally solidifying their absolute dominance. But recently, they've been trimming the fat. In 2025, they smartly divested non-core assets like Ikem and Musselwhite. They've perfectly positioned their portfolio to be lean, mean, and highly leveraged to the price of gold.
Section 3. Behind the balance sheet. Let's dig deeper into the actual cash generation, because at the end of the day, earnings on a piece of paper are great, but cash in the bank is what keeps the lights on and truly rewards investors. This $3.79 billion represents their jaw-dropping operating cash flow generated in Q1 2026 alone. Think about that, generated in a single 3-month period. This highlights that powerful operating leverage we were talking about earlier. After you cover the heavy capital expenditures of running global mines, which was about $641 million for the quarter, they are still left with mountains of free cash flow.
Traders and investors have immense confidence in the stock right now because of these fortress-like metrics. If you want peace of mind in a cyclical industry, this is exactly what you look for. Cash and equivalents are sitting at a towering $8.78 billion. Their debt-to-equity ratio is a remarkably low 0.15. Their current ratio is 2.3, meaning their short-term assets easily cover their short-term liabilities. And their interest coverage? It's over 60 times. This proves their liquidity is exceptionally safe, stable, and incredibly well contained.
However, keeping things totally objective in this explainer, we absolutely must note the other side of the ledger. Total liabilities actually expanded year over year, reaching $22.57 billion. Mining is a complex, heavy-footprint industry. Newmont carries large non-current obligations tied to asset retirement, meaning the substantial cost of safely closing down exhausted mines, as well as environmental litigation reserves. It's a vast, complex balance sheet, and while liquidity is excellent today, those long-term obligations are very real.
Section 4. Rewarding the shareholders.
So, with low debt and high cash flow, a company really only has a few choices, right? Hoard it,
buy other companies, or give it back to the owners. Driven by the Q1 beat and roughly $3.1 billion in free cash flow, Newmont unleashed a historic $6 billion share buyback program. This is a massive signal to the market. It tells investors that management believes their own stock is deeply undervalued relative to the cash they're generating right now. And they aren't just making promises for the future. We can see the tangible capital returns they've already executed. In just the first quarter alone, they repurchased $1.9 billion of common equity and paid out $387 million in dividends. And because of that fortress balance sheet, they did all of this purely from generated operating cash, without taking on any risky leverage.
Section 5. The road ahead.
As we look forward, all eyes are locked onto the upcoming Q2 earnings catalyst scheduled for July 23rd. The market is basically asking, was Q1 a fluke or the new normal? Analysts are projecting a highly elevated $2.20 earnings per share for Q2. Now, while that's slightly lower than the blowout $2.90 we saw in Q1, it would still represent a striking 54% year-over-year growth rate compared to the prior year. The expectations are heavily elevated, meaning Newmont needs to execute flawlessly to keep this momentum going. Wall Street is decidedly bullish heading into this print. When you have 18 out of 23 covering analysts absolutely pounding the table with a strong buy rating, it tells you that the institutional money sees a clear runway. For those of you tracking institutional sentiment, this is a glaring signal. They see the operational scale, the golden price environment, and the aggressive buybacks all aligning perfectly.
Even with a recent slight target cut from some analysts, the perceived opportunity is vast. With the stock trading around $93.20, the consensus estimate of $138.93 implies a phenomenal 46% potential upside from current trading levels.
So the crucial question to leave you with in this explainer is this. Can the world's largest gold miners outpace its heavy $22.5 billion obligations when they report on July 23rd? Or is this golden run about to hit some heavy resistance? The macroeconomic winds are completely in their favor, the cash is definitely flowing, but the expectations are sky high. Keep a very close eye on their cost controls and free cash flow generation next quarter. That's going to be the ultimate tell. Thanks for joining me on this deep dive, and keep learning.